let's go into the discussion. So idea is we went below this low. I don't want to sell it short, even though I'm bearish. So what's it likely to reach up into? Well, I'm thinking it could potentially trade up into this up close candle here. Okay, I'm thinking it could trade into that, the low or the open of that candle. So that's kind of like the magnet or the draw on liquidity. So it also could reach up into this little area right here because there's a fair value gap there. Just like we had it here and filled in, it can go right up into this, go right up there, and then still resume going lower. It might need to go up into that. So I went in this morning and I was watching the NASDAQ and the E-mini S&P. E-mini S&P had a lot of energy to the upside, and usually these markets move in tandem. That means they're generally moving together. And even though that NASDAQ was a little bit lethargic and wasn't trying to go up as quick and as fast as ES or E-mini S&P, the tendency is that it will be drawn to the same degree that the other indices were. So if ES was higher, NQ, which is NASDAQ futures, should be brought higher in sympathy. All boats rise in high tide, basically is what I'm saying. Now, if we look at the hourly chart, this is what I was seeing. I was trading all this in a demo account, and it ran up into levels that it became absurd now. So I satisfy my itch when I'm not trying to trade with the live account in the demo account, and I'll run them up real quick. There is no fraud required, or none of those things are required to make these things compound and blow up really quick in terms of the equity increases. But I'm going to show you how, even with a micro account. So, if you haven't already noticed, this is the micro E-mini NASDAQ. So every 1 point or 4 ticks is equivalent to $2. Okay? And I went in with the idea that I'm using a micro account with a discount broker, and the discount broker I'm hypothetically using while I'm taking these executions is I'm hypothetically trading with an AMP futures account. And I'll show you their margins and show you the details as to what I'm basically implying by doing these things here. Down close candle. After a run up, we retraced, went down inside this gap. See that? This area here, when it trades down towards this gap, this is the draw on liquidity up here as well, near term. So above these relative equal highs, we have what? Buy stops, or buy side liquidity. So I'm thinking that the algorithm is not letting price go lower. So it's going after everyone that's been profitable going short. So where are their stops? Right over here. So we're just going to call it 14,110. Okay, real simple. So the market starts to rally and leaves this down close candle. I'm going to watch to see if it can trade back down into that, because if it does, I'm going to treat that as a bullish order block. Remember what I taught last night? If the move has been bullish, down close candles should not be violated. Down close candles should not be violated. They're going to act as support. Bearish market moves, up close candles should not be breached and broken through. Never even come back to that one. So when you're bearish and you're watching the market go down and you see candles starting to form a potential up close candle, you as a neophyte that is new to trading, these are the moments where you get scared and you basically snap yourself out of the desire to hold the trade, and you just collapse the trade because you can't handle it. It's that overwhelming uncertainty that eats at you like mental cancer. It just literally makes you want to just get out of the trade, even when you're in profit. You ever feel that? The trade's profitable, and you're like, I just can't stand it anymore. I got to get out. You're making money. Your trade is profitable, quote unquote, in a demo. It's worse when you have live account funds and you have a profit. Because if you don't have the wherewithal and the experience of submitting to these ideas and watching them come to fruition over and over again, months of experience, not just a week or a day, you're going to feel like you just want to collapse the trade. So when I teach my students, when you're looking for a price move that's going to be a long-term price swing, not that this is a long-term price swing in the sense of time, but on this time frame for 1 hour, this is a nice decline. It's a prolonged price swing. It's not like little tiny little movements in here. And vice versa, we have it here. It's on higher. So all the down close candles, does it go below this down close candle when it starts to retrace? No. We expect this to be areas where they're going to accumulate more long positions. We retrace, going down into an imbalance, and then the market rallies above the down close candle. Does it support price? Yes. Time of day is important. So I'm watching when price comes back down into it here. I'm taking the opening price, extending it out in time. When that occurs, then I know I have a setup where I can go long. But I want to go into the time frames a little lower than the hourly chart to give me a little bit more context, because we do have a low that has a higher low to the left and a higher low to the right. So that makes this what? Intermediate term low. This retracement here, this might be trading into an imbalance, which is what I'm teaching you to look for. But the overall market structure is it's likely to go higher and aim for a run above these highs. Buy side liquidity resting right up there. So we're going to take these levels. This red level is anchored to this here. Relative equal highs. Buy stops are above that. Rallies, comes back down in. We're looking to see if it wants to run through that. Notice this high and this high. It creates what? Relative equal highs. Retail-minded traders are going to see that and say, oh, this is exactly what the texts say about resistance. So it's acting as a ceiling. Price acting like a ceiling. What should they expect to see price do? Go lower. So here's that level where the buy stops are. Or above it, rather. Here's that hourly down close candle, which is a bullish order block. Notice the down close candle is made up of two candles on the 15-minute time frame. Price moves away from it, goes above it right here. Does it create an imbalance here? Yes. That is how you determine your high probability bullish order block. It must have the imbalance coupled with the down close candle and the underlying narrative that it's likely to go higher to reach for buy side liquidity. Period. Okay, that's it. There is no engulfing candle does this. Forget all that. You don't need that. Okay, it's the gap plus the down close candle plus the idea that it's likely to go up for buy side liquidity. That's it. Okay, so I just noticed, by the way, there's a guy out there trying to hawk a $7 indicator, and he says he's the real deal. And it's all about order blocks. And might want to change the name on that. Just let you know. So we're trading down into this imbalance here. But now we're doing it at the time of day after the equities open at 9:30 in the morning New York time. So volatility. The initial move is technically the incorrect move going into the opening at 9:30. So this is like a Judas swing. So think about what we're seeing here now. The market's likely to go up above this level here to take the buy side because the market's unwilling to go lower. The algorithm keeps pressing higher, 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 higher. It retraces down into the 9:30 opening. This is that fake move. Don't chase this, and don't chase going higher right before the equities open at 9:30 either. So you have to take a step back and figure out what is you're looking for. Well, I'm looking for a discount market. Low. to high. I'm below 50%. Yes. I'm inside the order block. Yes. The equity's opening has happened. I'm bullish and it has traded lower. So public is going to be thinking what? It's resistance. It's going to keep going down. To what? There's your support level because it bounced there last time. So they're going to think there. Well, it doesn't do that. Down to a 5-minute chart. It hits the order block and then rallies. What is this? What's your favorite value gap? Market trades back down and overlaps that gap between this candle's high and this candle's low. This right here, that right there, that is one order block with a lower time frame order block and a fair value gap. You can take that trade if you know what you're looking for and you understand bias, narrative, and where the liquidity matrix is likely to lead to later on, which is drawing up above this red level here. Buy stops are above here. So if they're going to send the price higher from here and start rallying, that supposes that there's someone that got on board long here. Where would their ideal exit be? 6 points higher? 10 points higher? No. They're going to want to take it up here, where there's willing buyers with buy stops to protect their short positions. So when the market trades above that level, the buy stops become market orders to buy the market, which floods the market with liquidity. For those that have bought down here, they can sell to those willing buyers at a higher price, which they're waiting for down here and waiting for that price rally to go up. Now, as the market goes higher, the expectation is, and my expectation was, I want to go long in here and reach for this high. This was my entry idea, that it's overlapping, filling in that gap, and it's an order block here with a higher time frame order block there. So there's an hierarchy. Higher time frame to a lower time frame with the idea framed on it's going higher for buy side. I have an intermediate term low forming, and now this, when it fills in that gap, once that happens, what did I teach you last night? This becomes an intermediate term low. This low should not be taken out. Once it starts rallying, it should not come back down here. What else did I teach you? If price is going higher, down closed candles should support price. Well, it trades above it here. This down closed candle is high right there. It trades above it on this candle right there. It starts going higher. But then look what happens. It starts to go back down. It might go down here and stop me out. I'm not thinking that. I'm looking at this down closed candle thinking it's only going right back down into this down closed candle to accumulate more long positions. So smart money traders are going to be buying more here, like I did. Rallied. We have down closed candles. We went above it. I'm not worrying about the market as long as it doesn't take out these two down closed candles. Trades down, gets real close to that, but does it eat up and go through that range of these two down closed candles? No, it just retraces down into what? An imbalance. Why? So smart money can buy again, like I did. The market rallies again and goes into the buy side liquidity.